Hello, welcome to Chartbusters. I'm Nigel D'Souza and joining me is Ekta Batra. Well, we are in the thick of earnings season, so let's get straight to our first management that's standing by. Emphasis, they came out with their numbers midnight. They saw a weak set of numbers, actually. The revenue declined for the second straight quarter. However, deal wins were healthy at around $309 million. To discuss the company's fourth quarter performance in detail, as well as what's the way ahead, we're joined by Mr. Nitin Rakesh, who's the Managing Director and CEO of the company. And joining him as well is Mr. Manish Dugar, who is the Chief Financial Officer of the company. Hi, Nitin. Hi, Manish. Thanks so much for joining in. Well, let's focus on a couple of numbers then. Second consecutive quarter of a bit of a revenue decline. When do you see this pressure on the BFSI segment easing? Point number one. And point number two is supply side issues are getting sorted out, but yet you have lowered the upper end of your margin guidance. Why is that?
Thanks, Nigel, for having us. Let me take the first one, and I'll have Manish talk about the margin guidance and the band. If you look at the last two quarters, bulk of the decline really came from the mortgage segment that constitutes about, at this point, about 6.4% of revenues. Last quarter was over 8%. I think what's really going on there is kind of a freeze and a perfect storm in the mortgage segment in the US. Given the interest rate environment and the fact that the 30-year mortgage is at 6.5%, kind of a 40-year high. I think we are at a point where bulk of the decline is behind us. We think Q1 is the stabilization quarter. We are kind of near the bottom of that decline. So incrementally, we do believe that we will see stabilization in the mortgage business, and correspondingly, that headwind will kind of at least cease to exist. Either in the current quarter or Q2 onwards. So that definitely gives us some visibility to the overall direct growth actually returning back in the business on a sequential basis. And I think the other item that we can talk about is the fact that even in the DXC business, we have visibility to a stable outlook for the medium term. So I think those two were the big headwinds that seems to be behind us for the most part. The quantum of decline we saw in the last two quarters isn't something we expect to repeat. And as you mentioned, the deal-making activity continues to be robust. Pipeline is up 35-36% year over year, 9% sequentially. We had a large deal over 150 million with a new customer in BFS in Q4. We had a total of two large deals. So I think the deal activity is actually fairly robust, and as is the ability to continue to generate new deals. Manish, you can talk a little bit about the margin guidance band.
Okay, sure. Manish, go ahead.
Yeah, last year we had given a guidance range of 15.25 to 17. When the year began, we were not sure about how uncertain the macro will be. And as we all know, it kind of, had one negative impact after the other, the Ukraine-Russia crisis, recession, inflation, and then followed by the banking issue. As we get into this year, while we have reduced the guidance range from the upper range from 17 to 16.25, we feel a lot more confident about being able to expand from the 15.3% that we have been at for the last 4 quarters. So I think the real thing to be thought about is, 15.3 going up and not so much about 17 to 16.25, because that was a guidance, while this is where we believe we will be able to execute. We feel confident given the operational efficiency we saw kind of got eaten away by revenue decline. So as the revenue comes back and as we continue to focus on operating efficiency, we should certainly be able to deliver expansion in the margins in the coming quarters.
Okay. Nitin, just wanted to come back to you with regards to BFSI. While you have one deals within that segment, 2 deals, if I'm not mistaken, that's what you just said. What is FY24 looking like when it comes to BFSI in terms of deal wins as well as an overall outlook in terms of growth? The reason I say this is because Coforge was a bit cautious on their banking revenue just yesterday as well. So putting things together, what can you guide for when it comes to BFSI going into FY24, deal wins as well as growth?
I think for us, the bigger headwind really came from the mortgage side. That seems to be behind us for the most part. As we focus on FY24, I think the lead indicator for us always is pipeline. Pipeline for BFSI is actually up double digits YOY. While conversion timelines have extended and conversion from deal win to revenue is also extended, The outlook outside of mortgage continues to be, we have visibility into growth for the full year. But of course, we'll have to kind of continue to make sure that the environment doesn't get, over extended in terms of, the headwinds we've seen. As we stand today, while there are some headwinds.
On this. Just a quick follow-up. We have we're a little tight on time today, but I also wanted to ask you any kind of headwinds such as deal cancellations, delay in ramp-ups, which is already taking place across sectors?
Yeah, deal cancellations, not so much. I think given that a lot of these deals are in strategic tech areas, we haven't really seen a lot of, cancellation activity. Of course, there has been extension of deal timelines, both from a conversion standpoint and from a consumption standpoint. But that's kind of really, something that we called out last quarter as well. No significant deterioration there.
All right, Nitin, Manish, since Ekta mentioned we're a little short on time, but you all have hired a new M&A head, I believe. Are you all looking to...
That was done at the end of last year, yes.
Right. Is there something we should look forward to? When markets get a little bit dull, a little bit jittery, maybe some inorganic growth could pick up. Are you looking at any acquisitions?
Idea is absolutely to be a little bit more, curious, as they say. You should definitely look for potentially something that we can do in FY24. We are very actively working on unearthing capability as well as expansion-based acquisition deals.
Okay, all right, Rakesh as well as Manish, we have to wrap up on that note. It's been a pleasure, and I'm sure we'll get you on board again to have a longer discussion. Thank you very much for joining in and discussing your quarterly earnings. We need to take a break now, but we'll be back with more management. Stay tuned.
India has 7 crore MSMEs who encounter barriers to accessing easy credit due to lack of formal documentation and collateral. However, cash flow-based lending has emerged as a revolutionary solution to address this challenge. To capitalize on this, YouGrow Capital has developed GrowScore 3.0, an enhanced version of their proprietary scoring model GrowScore 2.0, by utilizing data from GST in conjunction with credit bureau and banking information. Imagine there's a small manufacturing company that makes custom furniture. Recently, they received an order for custom-made furniture, but to fulfill the order, they need immediate working capital to pay for raw material, new hirings, and other operating expenses. For that, they applied for instant credit with YouGrow Capital and shared their GST data to support their application. Now, YouGrow Capital will analyze the GST data provided by the furniture company to extract critical information such as sales momentum, purchase behavior, margins, scale of business, counterparty relationships, product mix, and filing discipline to calculate the Grow score and predict the likelihood of the company repaying the loan. Based on the Grow score, YouGrow Capital will make a data-driven lending decision and offer access to the credit to the company at a reasonable rate. This is crucial for businesses that can't obtain loans without collateral or face high interest rate problems. By leveraging GST data alongside traditional credit banking information, YouGrow Capital provides a streamlined lending process and quick access to credit when small businesses need it most. YouGrow Capital, empowering MSME ecosystem.
Welcome back. Well, we do have the markets which are consolidating, but 17,900 is here for the Nifty. So just about hovering around those levels. The broader markets are doing better, up around 0.5% at this point in time. We do have a couple of managements lined up. Now with us is the management of Indian Hotels, Puneet Chhatwal, who is the Managing Director and CEO of the company, joining in to discuss their fourth quarter numbers. Mr. Chhatwal, hi, thank you very much for joining in. You know, there was this interesting report which came out a couple of weeks ago comparing the hospital space with the hotel space. And I personally track the hospital space in terms of, how exactly occupancies are doing. But this time round, I'm more interested in terms of the occupancies for Indian hotels. It has moved up, but are you all back to pre-COVID levels? Are you seeing the same kind of business as you did pre-COVID? Okay, I think there's a little bit of a disruption in the connection. We'll connect back to Mr. Chatwal of Indian Hotels, but nonetheless, Nigel, it seems as though there's a lot of interest in the entire hotel space and the hospital space.
Absolutely. If you hospital space, I won't know too much, but the hotel space, I mean, if you just try to go for any kind of weekend, even if you go as close as Lanavla, you will absolutely see that things are chock-a-block, rates are sky high. And we'll pose that question to Puneet as well. Will there be a toss-up between the ARR and occupancy? Or does he see both of them go just north from here? Hopefully not, but he's back with us.
Yes. Mr. Chatwal, I hope you can hear me now.
I could hear you. Thank you.
Yeah. If you could start by discussing where business is currently, if you had to compare it to pre-COVID levels. Have you surpassed those levels? Are you back at the best rates in probably the last 4 to 5 years?
Yeah, I think we are far ahead of pre-COVID 19-20. Our reported results indicate a revenue increase of 29% or close to 30%. And on a like-for-like is north of 20. Our not like-for-like growth is boosting it to 30. And we think that, the best is yet to come with the buoyancy of G20, with the World Cup cricket ahead of us, with the return of the foreign tourist arrivals, which is still much lower than pre-COVID level. We remain optimistic also going forward on the outlook for the sector in general and Indian Hotels as the largest hospitality ecosystem in particular.
All right. Hi, Puneet. Your shareholders must be very happy with the kind of numbers that you're putting out. But as a customer, I'm feeling the pinch. So let's hope that things cool down from here. But good for your shareholders. Let's focus on international travel since you briefly mentioned that.
Nigel, I thought after last 2 quarters, the pinch would have gone. You might have got used to it by now.
No, I'm not able to still fathom that it's... and you're saying that the best is yet to come. So I was getting a little bit nervous out there. But be that as it may, let's focus on a couple of your numbers. International travel, foreign travel as a percentage of your business. How much is it right now? And how far are we from pre-COVID levels out there?
We are quite far away from the pre-COVID level. It's been an important part of our business for our palace portfolio. The palaces in Rajasthan and some of the other destinations like Goa. So Goa is really been thriving on the domestic, and so have the palaces in Rajasthan and Hyderabad, etc., done quite well. However, we need also the foreign tourist arrivals to go back to that 1920 and maybe with time far exceed that number. And that's why I think the best is yet to come, because at some point of time, this is going to happen. It's inevitable.
Okay, well, it sounds very, very tempting at this point. Palaces in Rajasthan and Goa at this point. But Mr. Chatwal, considering the bullish outlook that you're giving us, I wanted 2 parameters. If you've done occupancies of around 71% in this quarter, how much can you probably push it up to, or how much are you envisaging, considering that you do have the Cricket World Cup, plus you have the wedding season, maybe tourism will pick up as well? These 3 factors, and what would it mean for margins for you? Because you've recorded one of the best margins ever, 33% if I'm not mistaken. What is a sustainable level?
See, under our strategy, which we called Avan 2025, we have given the guidance of 33% margin. That is what we're going to sustain. That we are also growing our portfolio to 300 plus hotels and have a balanced portfolio, which means 50% owned and leased and 50% driven by fee business. That 50% owned provides the positive operating leverage in an upcycle, and the 50% fee-driven business provides the increase in percentage of margins because of the management fees coming in. So I think the combination of that has worked well for us. This is a guidance we started giving 5 years ago. We were partially derailed by COVID, but the brandscape has changed, has evolved. The business model has changed and has evolved. Now, to your point on occupancy, 70% and above is a very good occupancy level in order to get the pricing right. And with our diversified brandscape, but also diversified landscape of resort hotels and business hotels, I think we have been in a very good position to price our portfolio efficiently and drive also rates up. And when the rates go up, the bottom line obviously increases because the flow through is larger.
All right, Puneet, the margin number that you gave, you had given a 2025 guidance of around 33%. You're almost there. Do you think you hit that in this year?
Yeah, because I think it's not like you wait till 25 to do that. Our focus will remain on the diversification of the top line and still keep driving 33% margin. So that itself shows that our guidance was not unrealistic and very much in the future. So idea is to keep growing the top line, keep diversifying the top line, so that in good and in bad times, your top line is diversified enough to keep driving the bottom line.
All right. Puneet, from my end, one final question then. Sea Rock, what's happening? If you're saying rates are going to go up, occupancy is going to go up, I'm hoping that comes at least on the fuel cost. I save a little bit, right? On the travel, I can do some staycations out there since it's so close. Any further approvals have come through? If you could give us an update on that.
We are working on it. We are on the drawing board. But you asked me this question only 4 weeks ago when I was last on your channel.
But if there was an update, I just thought I'll ask you again.
Okay, Mr. Chatwal, just before we let you go, if you're talking about the ability to hike average revenue rates for your customers, how much do you think it can be to the tune of? Maybe 10%, 15%? What are you estimating in terms of the demand that you're looking at going into FY24?
Oopsie daisy.
Okay, so that will be a mystery. We'll try and get in touch with Mr. Chatwal to find out how much more expensive a hotel room can get from Indian hotels. But very good company. I mean, very good performance this quarter.
Absolutely, very good. I thought I heard him say that it's going to fall by 20%. No.
Fall. You're just desperate for Sea Rock to come on board as soon as possible.
Yeah, it's one of those, great properties. He's still with us. Puneet, you want to just quickly answer that question from Ekta? How much higher are the ARRs going to go from here? Puneet, I'll tell you what. Puneet, we spoke a month or so ago. I think in the next 1 month, we should get you back. And, we'll try to get you to answer that question once holiday season totally picks up here in India as well. But it's been good speaking to you. Hopefully, we get you on a better line next time. Slip into a short break. On the other side, we'll continue to focus on markets. Stay with us.
I am slow. I'm a tortoise. But your wealth managers, they shouldn't be as slow, you know?
Choose Nuvama. We move at the right pace because we only do what's right for you and your money. Nuvama. Let's do it right.
While a general has the power to cool, even in the hottest summers, its sustainable technologies help fight climate change and protect our planet. General, the extreme machine.
Z-Black Premium Agarbatti and Dhoop, official prayer partner, Delhi Capitals.
That's the boss's cabin. The canteen is behind. Morning, ma'am. Morning. And you are here. Good morning. Good morning.
मैम और कोई ऑप्शंस
लाइफ में और कहीं ऑप्शंस मिले ना मिले, मोतीलाल ओसवाल आपको देता है ऑप्शंस ट्रेडिंग में ऑप्शंस। इंट्रोड्यूसिंग मोतीलाल ओसवाल ऑप्शन स्टोर विद अ वाइड रेंज ऑफ ऑप्शंस इन ऑप्शंस ट्रेडिंग। एक्सप्लोर करो ऑप्शन स्टोर। Investment in securities market is subject to market risks. Read all the related documents carefully before investing.
Well, let's get straight to our special segment where we get you a few ideas for profit from Money Control Pro. Nitin Agarwal of moneycontrol.com joins us to talk about a stock that is tracking closely. Nitin?
So the company that I have chosen for today is Delta Corp, an online and live gaming company. Let me first touch upon its latest quarterly numbers. On a sequential basis, the number got impacted due to dry docking of one of its vessels. On a fuller year basis, the numbers have improved quite significantly. It is important to highlight that the company has recorded highest ever annual revenue of around 1,000 crores for the fiscal year 23. In addition to that, it has also reported highest ever EBITDA and net profit as well. Now, there are a couple of factors that make us upbeat about the company. The management has highlighted that the customer visits continue to be very strong, and the company is very optimistic about the tremendous potential that the casino business has in Goa on the back of the 1 crore with tourists every year. Apart from that, the company has been focusing on increasing its capacity and has ordered a new vessels and has earmarked around 250 crores for the same. The new vessels will have around 1,800 to 2,000 gaming positions, more than double the existing ones. Further, the Goa's land casino policy is expected to bring in the structural changes. It could lead to the creation of the gaming zone and formalize the industry. Delta, being the leader, is well placed to take the benefit of that. Apart from that, the IPO of the online gaming business could also further unlock the value for its investors. Lastly, without considering the IPO, the company currently trades at a valuation of around 12.9 times FY25 projected earnings, which we believe is very reasonable for a growth company like Delta.
Okay, thanks very much for that. On that note, we need to wrap up on Chartbusters. Stay tuned. Trading Hour up next.